CMQ investors? This is Chris Franco, and I've been receiving an endless onslaught of text messages, some DMs on Twitter. People are asking for my take on this, what appears to be kind of horrifying news about our U.S. economy. According to the Wall Street Journal, U.S. GDP falls 1.4% as economy shrinks for first time since early in pandemic. Let's see what's going on here. I'll give you my take, but if you're new to the channel, I don't necessarily try to just do, what's going on right now. But when we do talk about current events, as right now there's a lot of them to talk about, we try to relate it back to enduring investing wisdom from legendary investors, wisdom that really works for us as investors. So if that sounds like something you're interested in, the U.S. economy shrank in the first quarter as supply disruptions weighed on output. The decline in U.S. gross domestic product at a 1.4% annual rate marked a sharp reversal from a 6.9% annual growth rate in the fourth quarter. And that is coming straight from the Commerce Department. The first quarter was the weakest since spring 2020, when the COVID-19 pandemic and related shutdowns drove the U.S. economy into a deep, albeit short, recession. Okay, so what's causing this? That's what I'm interested in. The drop stemmed from a widening trade deficit. Imports to the U.S. surged and exports fell, dynamics reflecting pandemic-related supply chain constraints. Okay, so this is pandemic-related. We're coming out of the pandemic. That's good. As they say, this too shall pass. A slower pace of inventory investment by businesses in the first quarter, compared with a rapid buildup of inventories at the end of last year, also pushed growth down. In addition, fading government stimulus spending related to the pandemic weighed on GDP. Yeah, that makes sense. Consumer spending, the economy's main driver, rose at a 2.7% annual rate in the first quarter, a slight acceleration from the end of last year. So that sounds good, right? I love how this is pushed down to the bottom here. But that's what we should be really paying attention to, because it's probably indicative of a more, persistent trend. Businesses also poured more money into equipment and research and development, triggering a 9.2% rise in business spending. I just want to call something out, and this is why I take Charlie Munger's advice and just try to read very broadly. I was reading something actually last night, I forget who it was. It was an academic study, which sometimes can be like watching paint dry on the wall, but it was about the relationship between companies investing in R&D and future earnings growth, I should say. I don't want to give you a false sense of hope. That's not what I'm trying to do, but that's something I want to look into more, because that's a good sign. Even if it might not show now, it's an investment in the future, which typically shows up later. Diane Swank, who's a chief economist at Grant Thornton, said that the most important aspects of the domestic economy held up better than they did at the end of 2021, when growth was soaring. Okay, so there you go. 2 years after the pandemic struck, the U.S. economy faces challenges, including supply disruptions related to the pandemic and Ukraine war, labor shortages, and high inflation. Central bank officials lifted their benchmark rate in March by a quarter percentage point from near zero to tame inflation, and they have signaled more increases are likely to follow. Many economists, by the way, no offense if you're an economist, but economists are oftentimes very wrong. But there's something about the economist title that it carries so much authority, you tend to just perk up and say, oh, what did the economist say? Many economists think that the economy can withstand higher interest rates and return to modest growth in the second quarter and beyond, in part because consumers and businesses are continuing to spend. Americans are spending more on services amid lower COVID-19 case totals and the lifting of remaining pandemic restrictions. Travel is a key example. U.S. hotel occupancy was 65.8% for the week ended April 23rd, up from 49.6% at the end of January. That's interesting. So it makes sense. That's a good sign, from about 50% to 66% year to year. That's good. More people are also boarding planes, following a slowdown in air travel amid the Omicron wave. About 2.1 million people passed through airport checkpoints in late April, up from 1.4 million 3 months earlier. Cool. I don't want to read this word for word. I'm going to skip through here. I'll put a link in the description, though, if you want to read this full article. So I read the rest of the article myself, and I just want to kind of summarize the last part there that I skipped over. The uncertainty still, or the real concern still, is inflation. Rising costs for businesses, rising costs for consumers. By consumers, I mean all of us. It's not a good thing. I don't like the fact that there is high inflation, right? That doesn't make me feel good. As I told a colleague recently, though, it didn't take me very long to just accept it, right? What can I do about it? Nothing. But actually, I can do something about it. I can, maybe cut down on some expenses that are just kind of stupid. We all have them. It doesn't matter where you are in your life, whether you make $10 a year or $10 billion a year. There's always some sort of lifestyle creep that we often, or that often goes unnoticed until we have a reason to look, or at least have some sort of motivation to do it. So, I've tried to remind myself there was a time in my life when I when I had to watch every dollar I spent in a way that I fortunately don't have to now. I mean, I still do, but, I worked very hard to get to this point. And I'll say that I think sometimes it's easy to forget those habits, or you just, you're a little more comfortable, so you don't use the same sort of rigorous approach to managing your money. And I think that's a mistake. And it's something that this inflationary period is a great incentive for me to do. As I said, it doesn't matter. There's no shame in that. Some of the wealthiest people I know are the most frugal and cognizant about where every dollar is going. And I think there's something to that. It certainly aligns with what we talk about all the time in terms of what CMQ stands for, compound money quietly. That's the key to wealth, compound interest, the power of compounding. There's also reverse compounding. So when you have expenses that are just piling up and just wasteful, that's money that could be going in the other direction and going to work for you and adding to that and allowing your money to compound more forcefully or with more force. But, we oftentimes, because we're human, right? We're not as rational as we want to be. It doesn't always work out that way. So just a reminder there. But I think overall, if I could leave us with one thing here, and this is also for me, we can't get too caught up in this stuff. I mean, it's important to pay attention to it just so you know what's going on in the world. But, these things happen. This has happened before. The conditions are always a little bit different, but, there's been terrible inflation before. There has been, GDP slowdowns. There have been surprises that, economists did not predict. And I think if I could step outside of myself and give myself advice, I'd say, just stick to the game plan. Don't do anything irrational. For CMQ Investing, this is Chris Franco. Thanks for watching. Make sure you subscribe. We'll talk soon.